Hey there. Okay, let's talk about it.
Israel, China,
U.S. stocks are
67%.
tumbling for the second day. The Dow is already down.
Make America great again. America tank again.
Very, very tough. Very.
As you no doubt will have heard, on the 2nd of April, President Trump announced a sweeping list of tariffs in the so-called Liberation Day. And global markets and investors are still trying to digest the impact of it. The scale of these tariffs were much bigger than the market had actually initially expected, and it led to a lot of volatility across the board. You may have already seen equity markets have fallen, investors are grappling with the impact on global growth. A baseline tariff of 10% will be placed on all imports to the US, of which the UK will also face. 60 countries will be hit of higher tariff rates up to 50%. Countries in the European Union are facing 20% tariffs, while China will face a 34% tariff on top of the 20% increase announced earlier this year. So understandably, people are concerned, and I know it's going to be front and center of many of my client discussions going forward. So I wanted to use this video as an opportunity to not only acknowledge that and to discuss it, but also to go through some of my thoughts on how I'm going to be approaching it myself and with my clients. I want to just say first that it is really important to say that no one knows what's going to happen here, and any speculation on the data is just that. Something as complex as global supply chains and the impact of these tariffs can't be predicted, let alone the actions of a political leader who is famously unpredictable. Who's to say what of this is going to stick? So I'm recording this at the weekend. A lot could change, but what's happened so far? So the first quarter of 2025 saw global markets reverse much of the gains that were made at the end of 2024. The market seemed, after Trump's victory, to think that the administration and the majority he'd won would lead to even more US exceptionalism. To be honest, the US has dominated global markets for the past 14 years. The US market currently equates for 61% of equity markets capitalization globally. That means by size, for every pound going into the global stock markets, 61p goes to the US. I actually managed to find an earlier yearbook from 2012 where it also showed the global market caps. And 13 years ago, the US was just 46% of market capitalization at that point. So the US has grown significantly over that period, mainly at the hands of the US tech companies, later called the Magnificent Seven, ones that I'm sure you'll use every day. And that outperformance by the US is cyclical. We can see this data from Bloomberg, which compares US outperformance to outperformance of the rest of the world versus the US, where the blue represents US outperformance and the orangey color is when the world outperforms. The takeaway here is these relationships reverse all the time, although the US has been on a hell of a run since 2010. And this has been reflected in stock valuations in the US, and they have been what's called price to perfection, with investors globally valuing US businesses at a higher multiple and a bit of a premium, some would say. Valuations, as in what you pay for assets, are like gravity. Over the short period or even the medium period, you can push against gravity, but over the long term, it tends to be quite consistent and it does quite literally drag you down as far as returns. Let me show you some data which shows you the forward PE, which is price to earnings for different global markets. And the forward PE is a valuation metric that compares a company's current stock price to its predicted earnings per share for the next 12 months. You work it out by going forward PE equals current share price divided by projected earnings per share. And what it does is it tells you how expensive a stock is relative to expected future profits. A higher forward PE means that investors are expected to pay more for each dollar or pound of anticipated earnings. The more you pay for each dollar or pound of earnings, the higher the expected growth is. What this graph shows us on the zero, as in the baseline, is that's the US equity valuations. And here in the other lines is European, UK, and the Chinese market. So in purple is Europe, which is operating around a 25% discount in valuation compared to the US. The UK is a whopping about 42% discount, and China's similar. I actually thought this was shocking when we looked at the US based on valuation. Is every pound or dollar of UK companies generally worth 42% less than the US? So I think that's really useful to set the scene of where we are in relation to valuations and US performance. We have, without a doubt, had a decade of US dominance, and market prices reflect that. We've also seen politically now a seismic shift towards America First policies. So many people are thinking, will these tariffs be the catalyst to a reversal of fortunes in the US? Or is this just a small bump in the road on the incredible power of US companies and markets? So what were the tariffs announced? Well, they were unusual, let's put it that way. Trump's reciprocal tariff system calculates penalties based on flawed data. It uses a really simple formula where it goes trade deficit divided by the total imports, then halved. It doesn't account for services, where the US has quite a sizable surplus. It doesn't recognize legitimate reasons for trade imbalances. Okay, so I just want to explain how the Trump administration are considering tariffs and how strangely they're looking at this. Firstly, when a country trades with another country, if it sells more than it buys, it has a trade surplus. If it buys more than it sells, it has a trade deficit. We in the UK run a trade surplus to the US because we sell more than we buy, but we sell more services than goods. And that's what the Trump tariff ignores. The other thing that's really strange about this is a trade surplus or deficit is not a bad thing in isolation. Yet the Trump administration seems to believe that if you buy more from a country than you sell to it, that country is somehow manipulating you. There are, of course, extreme examples where there are currency manipulation. China, for example, has been operating something along this line for some time. But so many other countries seem to be caught up in this for no real reason. I mean, are the US really going to start competing domestically on, for example, Scottish whiskey? This sort of crazy catch-all logic is like saying your supermarket is manipulating you because you buy more from it than you sell to it, or that you're manipulating your employer because you've got a massive surplus with them. It ignores the trade and why you're doing it. So to recap, what the White House did is they looked up the trade goods deficit for 2024, divided that by the total value of the imports. Trump then, to be kind, said he would offer a discount, so halve the figure. It would be mildly amusing if it wasn't the global economy and real people's lives. So I think it's fair to say these are pretty smash and grab tariffs. You might be thinking, okay, but what does this mean for the UK? You know, I'm not going to try and think about the global markets. So the United States is actually the UK's largest trading partner. In the 4 quarters to the end of Q3 2024, accounting for 17.2% of total UK trade. So total exports at the end of Q3 2024 were 182.6 billion. Imports were 111.5 billion. It's important to bear in mind that just because there are tariff issues doesn't mean that trade will stop. There is, however, a fundamental and significant knock-on impact for the UK economy, especially when we look at it through the lens that the UK government's physical headroom under the recent stability rule that Rachel Reeves is so keen on is 9.9 billion. And that's a projected rule for the 2029-2030 fiscal year. This headroom represents a buffer between planned spending and revenue. So what we've got is currently planned spending for 2029-30 at 1.5 trillion, physical headroom 9.9 billion. That means that the physical headroom is about 0.66% of total planned spending. Or to put it another way, that's 99.34% accuracy that they need to land this and meet those rules. That means that if you were a weather forecaster and you were making predictions, to get that level of accuracy, you'd have to successfully predict the weather every single day of the year apart from 2.5 days.
And said she heard that there was a hurricane on the way. Well, if you're watching, don't worry, there isn't.
I was actually going to do a video on the spring statement, but it was a bit of a non-event with nothing really said and so much financial engineering to get really specific without it just being a political thing. So I didn't think it was that noteworthy. There was one insight that I think carries forward to this, which is that it does seem that Rachel Reeves and the Labour Party are very committed to sticking to this stability rule. And considering that doing that, they're already, as I've explained, on a knife edge, when we're now seeing the impact that you're going to see to global growth via these tariffs, it wouldn't be surprising in the next budget if they were to come back and say that they either need to increase spending cuts or increase taxes. There is some interesting insight in the current state of the UK mortgage market, which could change any day. But while it would be expected that tariffs might be inflationary, which could lead to higher interest rates for longer, at the moment we're seeing a reduction in swap rates, which is how they typically price mortgage rates. Fixed rate mortgages are priced based on the SONIA swap rates, which is the interbank lending rate. And it kind of gives you an idea of whether banks think mortgage rates will be in 2 or 5 years in the future. And you can actually see that around the announcement that the swaps rates fell on a 2, 5 and 10-year basis around the announcement of the tariffs. So keep an eye on mortgage rates in the upcoming weeks to see if they change. So what has the market reaction been? The market reaction has been pretty strong. The S&P 500, that's the US market, is down nearly 10% from the tariff announcement, putting it down 13% for the year. The NASDAQ, which is an index which tracks US tech, is down nearly at a 20% pullback, which would be officially a bear market. The FTSE's fared better, down just 0.81% year to date. There have also been some differences in sector splits as far as performance. So automotive was one that was badly affected. Technology's also been hit. People like Amazon and Apple, which are particularly reliant on import manufacturing, have been hit. And the least affected sectors at the moment are things like defense, because US defense products typically are produced on US soil. Also, oil and gas has been exempt from the tariff, so at the moment, energy has not been affected. So, that's all really interesting, but what can we do? And it's a question that I can imagine so many of you are asking. And while I can't say specifically because I don't know your personal situation, here's the kind of the 5-step game plan that I'll be working through myself and also with my own clients. And I hope you find it useful to frame these events. I think the first is just to accept it's okay to feel uncertain. Market events like this can and do feel pretty overwhelming, especially if it's trying to figure out something as complex as trade relationships globally. It's only natural to think about 1,000 negative scenarios and extrapolate it to different areas. It's totally normal, I think, to do this. What I think works is just to embrace that feeling, not push it away, and then reflect on it and make a conscious decision. Even a conscious decision not to act is a decision. And I think it's better to acknowledge that this is uncertain times than to try and fight that feeling. The second is just to reframe that volatility is the price of great returns. Volatility is normal. It's just the market digesting new information. And that information, which was digested quite quickly on the 2nd of April, could change equally quickly. Volatility is a feature of the market, it's not a bug. It's a natural part of investing. It's the reason why investments perform better than cash over the long term. In 2018-2019, we also went through tariffs. Admittedly not as big or widespread as this, but when talks broke down, US stocks sold off. When talks resumed, US stocks rose. The same was true for Chinese stocks. I think it's really true to say in these times, it's not investments that are tested, it's investors. This graph here, which I think is always worth bearing in mind, shows the calendar year returns for the FTSE 100. In the grey is the year-end return, so that's the return if you judged it on the 1st of January. However, in red, this is the lowest point the investment went in that year. What this means is if you looked at the wrong time, you could have a completely different picture of your returns for the year. We need to not get distracted by what markets do naturally, which is be volatile. The takeaway we need to remind ourselves is you still own exactly the same bits of the same great companies you did a week ago. Yes, slightly erratic view of the markets may have temporarily changed, but that can change again. And if you want to build or maintain wealth, being on the sidelines is unlikely going to be the best place to be. Number 3, and this is one that I have to try and remind myself all the time, don't be your own worst enemy. So I try and do this myself. I also encourage my clients to turn off the notifications on your phone. You are human, and every time they flash up, your kind of the lizard brain we all have operates on different systems. It's going to be really difficult not to be influenced by them. To the same extent, try not to constantly check your investments. There is not a single reason why you need to constantly check your portfolio if it's based on a multi-decade plan. The more we let our emotions get dictated by our investment values, be it positive or negative, the more likely we're subjecting ourselves to a roller coaster of emotions, which is probably not going to serve us. Number 4 is you can't control the markets, but you're not powerless. And this one's going to be a bit longer to explain, but it's important to do so. Let me start with an example of a client with poor planning. This is someone who's done a basic cash flow plan, and their aim has been to run down their assets at 99. On paper, this looks fine because they did straight line analysis. Eventually, their state pension kicks in and they thought their money was going to last. But the problem is they didn't do any stress testing. And this works in theory, but markets don't move in a straight line. So what happens if we now model a major market sell-off? Let's catastrophize and say that there's a 20% market drop in one year and another 10% the following year. This is pretty bad. And then a gradual recovery, so not an automatic bounce back. That's pretty terrible as an outcome. And while it's dramatic, the person who maintains the same spending where they had enough for the rest of their life goes out to running out of money at 78. That is well before their normal life expectancy, which is obviously a significant concern. That's why when I model for my clients, we always look over stress tests like market crashes, higher inflation, lower growth rates if one partner dies, You need to think about these things. But here's the thing with this planning that sometimes is overlooked. You are equally not powerless when markets decline. If you have a proper financial plan, you just won't continue to drive off a cliff. You can adapt. So let me show you another model with exactly the same really adverse market conditions. But this time somebody acts, they go, okay, this isn't going well. We're going to make a 15% reduction to my expenditure. While that's not preferable, I think most people would acknowledge they can make an adjustment to the discretionary expenditure if things go really badly. The impact of this can be substantial, just that relatively small tweak, and we go from the money running out in the late 70s to now the 90s, beyond their normal life expectancy. So when we add that together, and that's even without considering that markets typically bounce back strongly if they decline significantly, which this model didn't factor in. Spending often declines naturally in later life, and there are further mitigations many people have access to, like equity release should the worst happen. The real danger is that of human nature. So let me show you this extra one, which basically does the same declines, but let's say the person just gave up their faith in the markets. They went to cash and then they got 1% above inflation for the rest of their retirement, which as a cash return is generous. This is the worst of all worlds. They cashed in at the worst possible time, they didn't get any positive upside, and the money runs out at 73. That is a way to destroy wealth. The insight I want to give you here is that we can't control the markets, but we can also catastrophize worst case scenarios without factoring in our ability to adapt. And finally, the big one, the one that I will be saying the most in the upcoming months, whatever happens, is stick to the plan. Your retirement is a multi-decade journey. There are going to be bumps in the road. Maybe this is one. But imagine I'd told you on the 31st of December 2019 that you have your choice to invest or stay in cash. So you've got a choice to go in the global stock market or stay in cash. However, I'm going to also tell you that for the best part of 2 years, the global economy will be nearly shut down due to a once in a 100-year pandemic. After that, we'd see the worst inflation spike in a generation, a war, and constant political uncertainty. Would you, armed with that knowledge, feel confident in the markets? And what if I was to tell you that the markets actually, despite all that, would be up 64% in nominal terms over that period? Would you believe me? Morgan Housel has this incredible quote, which is, every past market crash looks like an opportunity, but every future market crash looks like a risk. That's why it's so important to avoid the noise and stick to the plan. And if you like that and want to maybe get that reinforced one more time, why don't you watch what I think is one of my best videos. It's a bit pretentious and the YouTube algorithm certainly doesn't agree with my views, but it sums up, I think, everything you need to know about that and investing through uncertain times. Thanks for watching.